Hey, and welcome to TSOB. This is a podcast for entrepreneurs who are interested in investing or starting their own funds. We are Adam Anderson and Zach Eikenberry. Join us to get a behind-the-scenes look at the relationships between founding entrepreneurs and the VCs that invest in them. Rhythm is a dancer. It's a companion. People from everywhere. Do. Little hands and voices. Free your mind and I have no idea what the words are. Little hands and voices? That doesn't sound right. Anyway.
Yeah, it could. My apologies. I need to go secure my office door real quick.
Okay. For those of you keeping score at home, secure my office door is a euphemism for Zach's got to go potty. That's okay. It turns out, nope, I was wrong. He literally was just closing his office door.
No, that was a euphemism for me going and trying to pee through this prostrate. Around it.
Secure the office door. God, this is getting off to a bad start or a great start. I don't know. I got things I want to talk about, Zach. What do you want to talk about?
I want to talk about your things.
You should. That's the right answer. Okay. I want to talk about where Hook Security is, where you are with your fundraiser. And then I kind of want to walk through my experience about setting up a special purpose vehicle. So why don't we get your emotional needs met first? And you talk about the current state of Hook Security's fundraising adventures.
Yeah. So I think last we talked, this is the end of November on the timeline for those people who have large walls with pictures.
Yes, year of our Lord 2022, yes. November.
We last talked probably in October. So we were coming out of Venture Atlanta. We had a really strong showing there. A lot of things in work, in play. And where things really shook down and really came down to it is for a number of VCs, any reason to back out or slow down would do.
Yeah.
Right. They would say, listen, we only invest in companies that, have more than 20 letters in their name. And sorry, there was just
we don't like the font of your website.
Yeah, we had, so we also got very particular coming out of Venture Atlanta because I think we realized how many VCs would waste time that were just in their pipeline. And they don't want to miss out on an opportunity. So they want to hear you out and what have you, but they have no conviction, no thesis, no belief in your space. There's not any momentum there other than oh, you guys sound really great. And one day we'll say, oh, we missed you. Right. And so you have that piece coupled where we were firing VCs who were not interested in actually writing a check. And then VCs who were interested they still are interested in writing a check and getting in with equity, just had concerns on numbers, on timing, and other things that are outside of our control. And so we have VC partners who have let us know that, they're in a position where they have to get buy-in from their LPs because they're not comfortable moving forward without their limited partners being engaged or otherwise, being good with the deal so that they look good and that this is a good time to write a check. We have others who, I talked to a VC, been around almost 10 years, 8, 9, 10 years, I forget exactly how long. Third fund, 180 million, closed earlier this year. And when I really pressed them into, what are you guys doing with this fund? Because you brag about having fresh capital, all this dry powder. And I said, what investments have you made this year out of that fund? Are you allowed to disclose anything closed yet? And, they were very sheepish when they finally admitted that they have written no checks.
Wait, look, so a buddy of mine, we call him Paul Trinder because that's his name. And he's the guy who used to buy boxes of Roman coins from Italy and dumped them into the tributaries of the lakes of South Carolina, because he thought that eventually, due to South Carolina's education system, he can convince people that the Romans were here first and just screw with everybody. But this is what happens when you have $1 billion exit. You can do things like that. And so we were in the same angel investing group, and we would show up and we would drink the free beer out of the cooler in the back of the room. And I remember standing next to him holding a Stella, and he's holding a Stella, and there's got about 60 angel investors in this room, and they're about to get started. And he said, look in front of you, Adam. Look at these 60 people who like to show up and pretend they have money. It's like they're all sitting on money, and none of them are going to write any checks this year. It's just me and like 2 other guys who do the investing, and the rest of them are here for networking and to be in the game. And the fact that you have VCs out there who are sitting on dry powder, why didn't they invest anything? Why, when they sheepishly said, hey, we haven't deployed capital, did they give you a reason for that?
No. I have to go on to the thought leaders online and the people that are out there doing other fundraising and see it from a macro position. I believe what's happened right now is we've come to realize that your valuation is what you can sell your company for. It is actually not tied to your internal metrics of your company. So it's like we've realized valuation of companies is more like appraising art. It has nothing to do with anything about the intrinsic value. Like, you could be painting in gold. It could be, 1,000 years old. It could be all these other things that we believe correlate to the valuation, but they don't. We have publicly traded companies right now that are trading below the cash balance on their balance sheet. They have more cash available than their company has said they're worth, according to traders. And so what that has done is it's pulled off all of the, we're a VC, we invest in companies that are doing 2 million in ARR that have this growth trajectory. We're looking for cash burn efficient, all these other things that they believe are metrics that correlate to valuation. They realize they cannot value these companies, right? And when you mess with the formulas and all the analysts, the principals, the junior investors at these funds, they don't have anything to keep themselves busy with because they can't tie what you're doing to evaluation.
Yeah. Well,
so they're kind of stuck. And what we thought earlier in this year, in 2022, people knew there was a correction coming, even like January, February this year. But we thought there's so much dry powder. There's so many activities. There's so many good opportunities. So many of the amazing businesses we enjoy today were started in the last downturn, that the dry powder would prevail and be the counterbalancing force, that it'd be a forcing function on these VCs to actually write checks. And in the aggregate, it's not happening. It's not. It used to be, 20% of the startups got 80% of the capital and interest, right? That's just the power law. That's just how it worked. It's even worse than that right now. So we're talking about total freeze outs of no matter how good your startup is.
So, and the cause of that is people don't know how to value companies or know where things are going.
Right. Yeah. And the speculation hit, so when all of crypto and Web3 collapses, we knew we had a crypto winter. What we didn't realize is that the floor of the crypto Web3 space, I'm throwing those together. I know some purists might not like that, but we've realized when there is no buyer, no appraiser, nobody to set a valuation on any token, on any coin, anything, that the value drops to zero. It's not there's not like a floor like, oh, well, there'll be a buyer of last resort. There's no buyer of last resort on crypto. There's no buyer of last resort on private equity, like especially in the startup space. And so I think you're going to see the fact that nobody is expecting a return on hurdle rates. Right. So I just mentioned something I should probably explain. The hurdle rate is the return you're going to get if you invest in debt or other long-term sustained equity, right? Like, so if the hurdle rate is now 5%, because that's what you can get on a treasury bond, you can put your money in and get 5% from the Fed. Fed rates have been going up. Or you can take a corporate bond, which has some long-term equity tied to it so that you're getting 8 to 10%. Now, for venture capital to work, it's got to clear 30% to make it even worthwhile. And there is no company that you can value and have confidence going into the next 2 years as a private equity venture capital group that clears that hurdle.
So, by the way, while I talk, you should probably turn your Slack off, because as I'm typing smart things that you're saying to Rhea, because I want to make sure we get the quotes, like valuing businesses is like valuing art, and there's no buyer of last resort for startups. I keep hearing my, notes coming in on your Slack.
That's right. That's exactly what's happening.
I'm hearing like,
so allow me to shut off my video while I put it in my,
yeah, well, I'm going to riff while you do that. You go ahead and turn off your video. The interesting thing about that 30% hurdle rate that you were talking about is, when a CFO of a large organization is trying to decide, do they fund an internal project, they typically look at a hurdle rate of about 16 to 17% IRR, internal rate of return. And there's a lot of ways you can calculate that, and we're not going to dive into it. Just Google calculating internal rate of return, and you'll figure some of that stuff out. Maybe we'll do a talk on IRR and in the future, and not right now though. But the fact that they're looking for 30% plus, or they're not even getting a look at it, is absolutely ridiculous.
That's return. That's cash returned on invested capital.
Sure. So ROI, not yes.
Well, so a VC has two marks, right? They can, especially in early VC. So let's say they invest in your company, $1 million on a $10 million post valuation. So they have 10% of your company.
Mm-hmm.
And then you go out and raise the next round and you get 20 million post. Well, they've marked up 100% on their book, right? So they've doubled their money according to their book, but that's not cash out. That's not cash on, and that's not return on invested capital as in cash.
Mm-hmm.
The VC still has to wait for a liquidation point, an acquisition, IPO or something. And what they need to do is so they know that a number of those companies will continue to get markups and paper marks, but might still go to zero as a company.
Mm-hmm.
And so they have to wait 5 to 7 years to clear 30% on the companies that do win. It needs to cover the losses of their bad bets, and
right.
It has to return 30% on cash. And so
maybe they should stop making bad bets. Never mind. Keep going.
I think that's the rate. And I'm using round numbers because there's a compounding level, but when compared to the treasury bond or corporate bonds, like that's the hurdle. Mm-hmm. Otherwise, you put your money into treasury bonds and corporate bonds.
Right.
And you have a floor because you know that it's backed by the U.S. government, the credit and faith of our U.S. Overlords, where crypto has no backer, right? If the buyer goes to zero, like right. And even on top of that, like there was a mindset introduced, right, of too big to fail, where even speculatory trading could get bailed out by the federal government. So like in your corporate bonds and your equity bonds, like if you remember, like Ford and all these other car manufacturers got loans from the federal government, like that was a signal to the world that U.S. companies are not risky. And so it really jacked up the risk analysis on creating what most investors would believe is a true pool of zero risk assets, which are like corporate bonds. It used to be corporate bonds could go to zero. Not with the big corporations. They're not going to zero.
No,
and so the
they're
hurdle
not going
rate's
to.
there. And the hurdle rate previously, before the Fed rose rates, right, was, well, you got to get a hurdle rate of 12, 15 points.
Yeah.
And so as a VC, while you had capital freely flowing, and like it worked both ways, you might as well make more bets with higher valuations to entice the next VCs to buy, because the other VC funds also have money further up. And so, yeah, the house of cards has fallen. And really what you see active today are funds that are the equivalent of super angels, where there's one or two personalities and GPs with their capital at risk who are willing to lean in and make deals happen. Those are the people that will really come out and make great money in the next 10 years. The VCs, who are all Ivy League backed analysts, who are nothing more than hedge funds in the space, are all going to hold on to their cash, even if their cash is devaluing over time, because they have no way to actually, get the right kind of gut calls and understanding of the world to make true bets. And that's just how it is.
So how long are these markets going to be locked up? Or actually, I'm not going to ask you to predict that. That's the new reality. The new reality is if you are raising a Series A or above, capital seems to be locked up. And that's, I believe, because people care about returns. When you look at seed level investing, it's often an emotional thing, especially if you're doing a friends, family, and fools round. What are you seeing for seed companies? What are you experiencing, and how is that affecting your current strategy?
I am seeing that seed round funding is also really wonky right now, because the seed funders want to know they're building a bridge to somewhere. And it used to be that you just needed to build a bridge 12, 18 months, get product market fit, make sure you have a couple key hires,
Yeah.
show some traction, and the A people will come along. No one knows when the A people will come along.
Yeah.
So
seed
now,
better get you to profitability.
Well, and people aren't optimistic about that. Seed more than likely drops to zero by the time the bridge comes along. So, like, if you had a 50% chance of getting to a bridge that's a mile away, and when that bridge becomes an unknown distance away, what is your likelihood of getting there? Even seed people they say two things outside of that make them say no. They say, you're raising too little, and and then when you raise it, your valuations are way too high, because you're going to, it's just, if you're a seed funder right now, in order to get a deal done, you should probably expect to move beyond the 10 to 20%, and you should expect to sell 30 to 40% of your company to raise the right type of bridge that makes a seed person happy. So I was talking with a startup founder last week, and he was like, I got to it's really an angel, like, they said that they were good for like 750K, but they want to have 30% of the company.
Wow.
And, they want a board seat, and they want all this other stuff. And they also said, like, the seed funder was like, you're going to have to get your salary approved by me. As a founder. And right, like, and he's like,
I mean,
I don't.
that's not out of line. I know a person who took venture debt and that converts, and anytime and she pays back the investment based off of profit. And so part of the deal was any salary that she takes over 100,000 is considered profit. Like anything, she can't pay herself over 100,000. Otherwise, she's double dipping. And so those kind of terms are not rare. what you just described. Hey, I'm going to give you 30%, but it is rare when you've got a company that's already hit $1 million in revenue, that has been in existence for almost 4 years, that is scaling the way that, I mean, that's for a brand new newbie company with no track record at all. That's shocking that that was the terms that you got with where Hook Security is right now, which is, and I might be biased because, for reasons, literally a textbook. This is how you do it. This is how you hit the metrics. This is like every step of the way. You look exactly like the playbook that you need to look like to continue to win this game inside of the capital markets.
Yeah. And I think the issue is that we can own at Hook Security is we did build to what people wanted us to get to, right? Yeah. And we waited until those milestones to go raise capital and a few other things. And right. What I've come to learn is those VCs were just kind of making it up themselves. And they would get on panels with 2 or 3 other VCs, and somebody would say something that sounded about right, like, well, there really is a distinct threshold around $1 million ARR we have found in our research and portfolio. And the other 2 VCs on the panel are like, okay, taking notes. We now do $1 million.
Can't wait for this echo chamber.
Yeah. And so what happened is when all of that shifted and all of a sudden people didn't trust what other VCs research or the echo chamber proved to like lead them into higher risk, they shut and killed all the ideas that they had been promoting. So you're not going to see, I can guarantee you right now, the echo chamber, if you go to a VC conference, is going to talk about cutting spending, buckling down, getting back to basics. The time of free money is over. And, we're really going to be interested in backing ideas of founders who are ready for the next generation, blah, 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 blah. But they themselves have to deal with the fact that they have Web3, crypto marks. They believed in various AI. They believed in deep tech. That is, the deep tech itself was going to cost, everybody knew, $100 million to build. They put in 20 million when capital was free. Yeah. Now capital's not free. And there's no hurdle rate, and they just built a bridge to nowhere with their deep tech.
Nah.
So I think VCs in general right now it's okay that they are more concerned about their survival than their immediate cash flow survival than they are about any investment actually getting through. So like a VC who says, we want to see a better world, we want to change and all this, they're like, no, not at my expense.
Well, so let's talk about what that means. So what you're talking about then is, when you say a VC is not spending money to survive, some people might think, no, a VC has to spend money to survive. And that's not quite so there's 2 ways a VC makes money. Their first way is they share the ride on the exit with their limited partners, with their investors. So they have aligned incentives. Hey, I'm going to do a 20% carry after you get your money back, and I'll take 20% of the profits of this investment after you get your money back. And that's where you make the real money. However, there are an awful lot of VCs out there who make their living with management fees. And usually the way a management fee works is there's a certain percentage, an industry standard, which means it's probably not that standard, is a 2 and 20 split, meaning a 2% per year management fee on the amount of money you raised and a 20% carry after the VCs get their money back on the profits of the exit. So when you're saying they're buckling down, what they're saying is, I don't know if I'm going to be able to get another capital call. I don't know if I'm going to be able to raise that next tranche of this $100 million fund. And but because I'm doing this management fee that they agreed on, let's say, so what's 2% of 100 million? Is that what, 20 million? No, 2 million. 2 million. So they're making $2 million a year off of that 100 million due to the management fee. And if it's a group of, 10 people who are running this fund, then that means that everyone's making a pretty okay salary. You've got probably a couple of general partners who are making a decent salary. You've got, the front desk person who's making like 34, whatever, right? And so when you say they buckle down, what I hear you saying is, let's just survive on these management fees. Let's not deploy our capital. Let's hold off until we feel confident to get back into the water again. But there's no incentive for them to deploy capital, in a hurry.
There is a small incentive for the team. All right. So a way a number of these funds will actually work. Let's say they have $100 million fund. They will give incentives to, if they decide to invest, to the referral sources that brought them the deal, to the due diligence team, to the, if somebody cold called and got the founder on the line and did all the work, right? So let's say they go and they say, we're going to invest $9 million in this company. But their draw on the 100 million is actually 10 million, and they
Right.
pay out small bonuses and other admin incentives with the last million. So they actually draw 10 million from their fund, and they have these little riders of the deal carry cost and the underwriting costs of the deal itself that they pull out of the fund. So the GPs and other people get little bites at this along the way for their deals to go. And that's part of the mechanisms that's supposed to unfreeze it. But right now, that number is not big enough to convince the risk.
Right.
And so a GP is like, I'd rather not put that $9 million to work.
Right.
Because if I don't see the hurdle threshold being covered, and I think what's actually going to be at issue here is it's not going to be the true tech or the true innovations that win these VCs because they're so emotional, they're so volatile. It's going to be the best founder pitchmen and women. So if you're a woman who can pitch a founder or a GP better than anybody else that's pitching to them at the moment, and they want to kind of get a deal done, and they like the space, and they like you, and they want to brag about this logo, and they're convinced that you've got this plan will get you enough capital for 3 to 4 years, 3 years or so. And that if you can pitch them well, you're probably going to pitch the next guy well. So as a female founder, good pitch person, I'm going to take a chance. I'm going to risk. That's the deals that are going to get done by the actual VCs as they do get done. So you're going to see a floor. So it's not going to go to zero. So when we see we'll say my prediction is we'll see VC investment cooling off. We'll see it, and people will frame it as regressing to the mean. But actually,
that was my entire dating strategy in college, was regressing to the mean. So what? Keep talking. You sound good.
No, I wanted to make a Taylor Swift joke about why you gotta be so mean.
No. That's still too soon.
Why you gotta be so mean?
Because I'm regressing.
So I think that's the so you'll see a floor, and people will spin it as VC money has not gone away. Deals are still getting done. And I'm going to say it's super angels who are still passionate about certain sectors and founders, and superlative founder pitch people.
Yeah.
Founders who show up with data, and they're measured, and they want to get a deal done, but they're going to make sure everything they say is true, are going to be punished by venture capital. That's my prediction. It's the founder who shows up and says, and is able to PT Barnum the GPs.
Mm-hmm.
That's the founder that's going to get money.
Yeah. By the way, I said I once dated a girl named, average, but that's also kind of how dating works. It is the confident person who gets the phone number, right? Mm-hmm. It's the person who has the ability to present well, to get by the first parts of the human reaction to another human in a positive way, that is able to take the next step. And so, yeah, what you're really talking about is human nature. And you're saying that it shows up in the venture capital world, and maybe it's always been that way. Maybe
it's always been hierarchical, right? Like that's right. So when raising money, when selling your equity, you're not competing against other people in your industry. You're competing against the sum total of everywhere a dollar could be placed.
Right. That's a good quote.
So yeah, it's always been, but when the hierarchy was open, right? And it was, right now, my point is it's always been 20% of the deals got 80% of the attention in funds.
Yeah.
Right. I've that's the power. That's just the law of the way of the world. Cool. I'm not fighting against that. What I believe is happening now is 1% of the deals are getting 100% of the funding. It is the hierarchy in the pyramid that you can ascend just, and the people that are going to make it to the top are the who's who of founder funders. And so it's pretty devastating. I I I hope in the long run the powers that be politically understand that like printing money has a devastating cost on people.
Yeah.
And it is not worth it to have to deal with this inflation print and raise rates, because all we do not know, like the inflation is, there wasn't enough supply for the demand. So much demand, all this money out there, and supply, the pricing goes up because there's not enough supply. The only way we know how to deal with it is to destroy demand.
Yeah.
Raise rates. And now we find an equilibrium where inflation kind of stops, right? But like, if we could figure out a way to actually increase supply, that would be better. But rather than increase the supply of homes, we decided to destroy the buyers.
Come on now.
That's what we did. That's what the mortgage rates go up because they're based on the 30-year treasury. So I am hoping that other founders like me and what have you realize that it's a dangerous game to play to when the money is the money supply is controlled, managed in a political way, that your vote to vote yourself more money just devastates you. So whatever this founder entrepreneur class is that's emerging, I hope that there's some lessons taken about, like, there is no such thing as a free lunch. It kills you when you have to, try to work out inflation out of the economy.
Right.
So, especially if we want to be the reserve currency of the world, but I'm not getting into monetary theory right now.
Well, yeah, I was about to get super bored. So I was like, oh, tell me more about. I mean, I'm sure one of our 6 listeners was fascinated by where you were about to go, but let's be honest, none of us like Carl. Okay. So let's piggyback and then let's riff a little bit. So one of the missions of Hook Security is something that you and I are taking very seriously, which is child safety online. All right. So that's the thing that I'm trying to build a nonprofit to do. I've been working with a lot of, and honestly, having a 14-year-old daughter and an 11-year-old son, I'm like right in the thick of it. And I have become extremely frustrated trying to do the nonprofit side of the house. Nobody cares. Let me rephrase that. Everybody says they care, and then nobody writes checks. Or there's 1,000 other nonprofits trying to solve the exact same problem. They have to choose, right? So one nonprofit makes the money, gets funded, boom, boom, boom. So one of the reasons that we did Hook is because you are truly gifted in the K through 12 space. The problem that we're trying to solve is child safety. And a way of doing that is through cyber awareness training. And our idea was, let's make the money off of the corporate compliance model and the corporate security model that has budget, so that we can then innovate and really get into this K through 12 space. Is that a fair statement?
Yeah, it definitely was one in which we can only be as successful in K-12 as we are in the larger corporate world. And we wanted to be wildly successful in K-12 with young people. So we needed to build our proficiency in the corporate world.
So as I'm watching you run this company, again, chairman's so much better than CEO. I got to tell you, it's the best. I got to go get on stages when I want. I don't have to. It's the best. And no jokes about which stages I was on, please, Jack. That's a restraining order. And anyway, so
regression to the mean.
So
it's like, in our 2022 and never mind, I'm not going to.
You really shouldn't have. That is a fantastic adult decision you just made right there with your brain.
Can I chat? I'm going to chat you the joke.
Yeah. Just send it to me in Slack. I'll look at it later. So the idea here is, how do you do good things in the world when the capital markets are locked up? And so I found out that what people are still spending money on is status. You really did. You really are sending me the joke, aren't you?
Yes, I am.
Oh God. Okay. So while we're doing all this work, I decided I wish I just had enough money to just write the check. Oh, that's okay. I just read the joke, and you made the right decision to not say that out loud.
That's right.
Wonderful. I mean, look, Carl would have loved it. Carl's all about that kind of humor, but my God, you should be ashamed and kind of proud. All at the same time. Proud. Yeah. Anyway, so if people are still spending money on status, like, by the way, one of our good friends, Sarah, who you know from DCBKK, she started a luxury travel business in the middle of COVID, targeting ultra high net worth people. And she has just hit the 5+ million revenue mark, from 0 to 5 million in 3 or less years, because the high net worth are still trying to travel. They're still trying to live their #best life. So, one of the things that we're talking about is, space whiskey. Right. So I've decided that the right answer is to sell a product that people desperately want for a status perspective, and then to make massive amounts of money and then turn around and solve the problems that I actually care about myself. Right. So if it costs X million dollars to, start doing some of the work we want to do to protect children, and we're not able to get that as fast as we want, I'm like, screw it. I'll just make a barrel of space whiskey and I'll sell that sucker for 200 million. And then from the, the profits, I will turn around and do good in the world. And the interesting thing is that it resonates with people. Not that whole story, but man, this is fun. This is cool. I have to buy my Range Rover at the end of the year because whatever, right? They're still spending money, is what I'm saying, is that people with money are still spending money. What they're not doing is putting it into capital, to institutional investors' hands to actually go do the thing.
That's right. Like, the irony of high net worth people when it comes to inflation and dealing with uncertainty is it drives their buying into the present, where they no longer think long term, because the long term doesn't make any sense to them. Like, the super long term does. Like, they will buy and hold something for 10 years plus, right? Like, they might and you still see little spikes, like we mentioned art earlier, like art auctions are still going strong, right?
Yeah.
I plan to buy this piece of art, hold value for 10 years in a vault, and then, like, ultra high net worth people are doing that activity right now. But you're seeing a spike in luxury travel, luxury cars. I'm told there's a spike right now in speculation around horses and racehorses and thoroughbreds in particular. Ultra high net worth people.
Have you been looking at my bank account again, looking at how much? Did you see me? I just bought like a glued charger.
Yeah, I appreciate that all the horses you've bought are named after ex-girlfriends. And so regression to the mean is one
Yeah.
of your best sources, thoroughbreds right now.
So good. And regression to the mean does the best she can. But you get it. You get it.
Yeah. So I think that's the interesting thing about ultra high net worth people who are already insulated somewhat from the economy. They have no incentive to make medium to long term bets. So they either need to make ultra long term bets, leave their money in a trust, leave it in real estate, leave it in pieces that hold value long term, or consume with it now, right? Like go ahead and buy the depreciating asset because it doesn't matter because like all their other investments are going to depreciate. So if you might as well bring all your joy forward.
Right.
And it's the counterintuitive thing where they will then turn around as LPs and tell their VCs, everybody else needs to save money right now because there's no more money coming. I'm going to put it into, so like, I think you'll actually continue to see strong aggregate philanthropic giving because through the 2020 and 2021 boom, we saw the greatest jump from the middle class into upper class levels, the greatest economic mobility yet in human history at an international level. And I think what that does is it's finally freed up some people to begin giving, and they're going to continue to give strong. So I actually don't think you might see a dip in corporate gifts, but I think individual personal gifts, I would actually imagine we see that hold strong.
Well, that goes back to your super angel comment, right? You've got somebody who has, made enough wealth that the current economic turmoil that's happening sure might make them aware, but they're not going to stop doing what they want to do.
Mm-hmm. Yeah, I think so. But I don't think you'll see them buying $100 million homes because the mortgages on them are just too much, and they're just not. If they already have the homes they need, they're not buying up additional. But they might, there was somebody who had a farm next door to one of their properties, and it's on sale, and it adds a little value, and they might as well consume it now. I think you'll see that type of behavior.
You know what I want to talk about next?
What?
Cap tables. Yeah, all over the damn place, man.
No, it just every time we just have to keep getting to technical cap tables and how those work. So that's a joke. You never talked about
I have been in a lot of different deals, and I've talked to a lot of different people about cap tables lately. And in my head, you have what I call the friendly co-founder LLC cap table. And then you have a institutional investor focused, raising money focused cap table. Right. So I was sitting there smoking cigars with two of my buddies. One of them had a great idea. I said, that's great. And I looked around the table and I said, you're 51%, you're 54%, and I'm 55%. And we all shook hands. And now that the company is formed and we're done, we're moving forward. Right. That is an LLC cap table amongst three fools who are going to go do a thing. And that's great. Mm-hmm. When you have that mindset, when you go into institutional investor cap table, where optics in the cap table is one of your selling tools that shows what you're talking about, it is really, really important to have that conversation up front with your co-founders about who's getting what kind of equity and all that kind of stuff. So if you were going to talk to somebody who was setting up their cap table for their SaaS startup, and there's a couple of co-founders, walk me through what you would coach them that cap table needs to look like.
Well, if it's their first rodeo, I would actually encourage them not to over-engineer their cap table. Okay. And there's a book out there called I got nervous that I'm going to say it wrong.
Something the pie, or
splitting the pie, slicing the pie.
Slice that pie up. It's some pie stuff.
Yeah. So which just talks about very simple metrics about what needs to be reserved for follow-on employees, what needs to be allocated for capital or founders, et cetera. And it's really just kind of based on role and value add. And I think that's part of where a number of people make mistakes right now is they believe equity should be paid for the trade-off of what I could be making elsewhere, right? Like this is how much I'm sacrificing to be part of the company, so therefore I should get X amount of equity in the company. I actually think equity needs to be more aligned to the access to capital and the capital that somebody brings in, and not non-revenue. Like I think revenue should be paid out in commission and cash. Equity should not be paid to just people who are only going to do sales functions.
Hmm.
And because I do believe, yeah, we're living in a world in which too many people have too big of disproportionate value on equity tables when the real deals are done through capital allocation and capital sales. Like, so if you're not in the business of buying, selling, and trading your company's capital at some level, or sorry, your company's equity, that's what I'm doing as CEO. I'm buying and selling, I'm trading, I'm negotiating equity. I've kind of come to a conclusion that you should probably just have options, and not shares of the company. You should have options and rights to buy shares over time, but you shouldn't have equity out of the gate. Equity should be a high bar level reserved for the people who want to trade a deal in equity in the company's future.
That's fascinating. One of the problems, where that goes is I have a lot of pressure in my head to allocate equity up front and maybe have vesting or whatever, but I'm always worried about that taxable event when you give somebody equity and now it counts as income. But what you're saying is you dodge all that by saying no. 100% of the equity is going to be handed over here. We're going to assign all these options. We've got an option pool set aside. And because you are a wonderful human being and we don't want you to get a whole crap ton of taxes on a 10 million valuation company that has $0 in it, we're going to do options.
Yeah, that, or if you want to lock in key employees, you could do phantom equity, right? Where the issuance of equity is only at the liquidation event. And so
I used to have a horse name liquidation event when it became glue.
It's a great way to say your ex-girlfriend's name.
I did that. You got it. Yeah, I was gonna say you would say the girl named Phantom Equity, but
yeah, that's what I've believed, because right now, like even at Hook, I've seen a bunch of folks on our cap table with fully vested, fully charged equity, and they have nothing to do with equity. Like they don't carry the weight of it. They've totally outsourced it to myself and you, who are out there trying to sell, use, leverage, price, get terms on the equity. Like we're doing all these things on the equity. Equity is part of our world. And there's a bunch of people who it's not part of their world, but they get to participate. And in my next go around, I'm fine to be generous with equity, but it's going to come in the form of phantom equity and options packages, maybe a warrant here or there. But the lion's share and the money is going to be held by the people who deal with equity. And I think that's a different point of view. I don't hear a lot of people talking that way.
Right.
You hear people who bootstrap and want 100% of the equity and never want anybody to ever deal with it. All the employees work for me. And then you have these people on the other side who are like socialist with their equity and everybody gets a piece of it. Like I said, great. You're going to bring in key customers and get all sorts of revenues, etc. Awesome. You can reserve some of your commission payments and have an equity buy-in at a liquidation event, or your options package can reflect that. But I'm not giving, unless you're buying and selling equity and you understand how it works and you're part of the conversation in the room with a venture capitalist or an investor or an investment bank trying to get the IPO done. If you're not in the room doing that, then why the hell do you have equity?
Exactly.
That's my point of view on this right now.
I love it. Yes. Yes. So equity is not a reward like a trophy you put on your mantle. Equity is an invitation to participate in the business in a different way and to have different thoughts about the business, and that should affect your behaviors. What do you do? How do you help the business that you have equity in? Well, you make that equity more valuable. You get
You
obsessed
buy and
about it.
sell. You're
Yeah.
part of, like, if you're not, we have people who have equity in Hook, like full bore equity, and they do not bring investors in. They do not talk about investors. They do not care about price marks and terms. They do not care about liquidation preferences on the next round. They don't care about any of that stuff. It's not part of their world. They just go about pulling their own levers. Some of them have faded off into the sunset and they
Yeah.
have equity in our company. And which at the time is perfectly fair. I'm not reinventing and saying, oh, I wish I have no regrets about it. But in the next rodeo, it's going to be
Yeah.
the equity is held. The equity is held to only the people who, at some part in their job description, actually care and deal with equity itself. Period. Otherwise, here's your options. You have a right to buy some equity in the future. We gave you options, so it's a nice taxable event. You can invest into them over time, and that's all in the future. And
Yeah.
when all these things come together and the last mile and the last minute and the company is assembled and it's liquidated, then you can participate.
Well, I know you're not a CPA, but if someone gets allocated equity and then that vests, where's the tax event? Is it when you just were given X number of equity, or is it when it vests, and is it set at the valuation at the time of the vesting, or is it set at the valuation at the time of the issuing?
It's set at the time of the issuance. So whatever valuation, so there's a strike price, is what most people will call it. It's your right to buy. So options are, let's say you get an options package and it says you have a right to buy options at 5 cents an option or
Cool.
5 cents a share. And then when it goes to liquidate, the company sells at $2 a share.
Right.
You get sold and taxed on that 0 to 5 cents. That's your zero, that's your capital gain, and you don't get taxed on the rest of it,
Cool.
right? Because
Cool.
it's as if you went back in time and bought the shares and then watched them grow
Sure.
over time. Now there are a couple scenarios which that messes things up if you don't like report it to the IRS correctly, and a few other things. Our I's aren't dotted, T's aren't crossed, that you can stumble into income tax and capital gains tax. Now, I do believe now there's, with the new tax rules, there is like a minimum tax you have to pay on that gains. I don't think it goes completely to zero, but and it also depends. State income taxes are starting to be a real big deal with these options flips. So that's why you see a number of folks move out of California and other places with really high state income tax, like New York State, and like Florida and Texas are great because their income taxes are really low. Florida's zero, of course. So though all those things matter at these liquidation events, and it all builds in. The government's going to get some part of it.
Sure.
But I think that's the difference between so options have a couple of things that you get your vesting over time, and if you like leave the company, you have like 90 days to go back and actually buy, or else the options expire, right? That's pretty typical. I've been a fan, and I think I put it in there that you have a year to buy the shares, right? Like if it's not just 90 days, if you leave the company, you have a year to go back and buy them because you might not have that money right then. And there's a few other things. And like, if we issued you the options, you have the option to buy, right? I am aware of a few companies out there who just started saying like, you have 5 years to buy them. So if you leave the company fully vested, you have 5 years to go back and retroactively. But that's I don't know. I think that's a little outside the norm still.
Yeah, but isn't that where our industry is right now? Everything is outside the norm.
Yeah, there is no norm. I think taking a 2 to 3 year hiatus from IPOs is going to set back all this, oh, you should IPO in, 7 to 10 years. I think the norm is going to start being people are going to be like, yeah, it takes 12 years to IPO. And then now VC funds are going to be like, oh, shoot, if it takes 10 years or 12 years to IPO, my fund's 10 years.
Whoopsie.
So they're going to have a rolling funds, and they're going to have to start having fund lives of 20 years or more. And how does an LP lock up their money in high risk venture for 20 years?
Yeah.
Maybe they only allow capital calls for the first 5 years or something. But like it's going to create weird incentives, and the VC industry is not prepared to rebuild itself with new metrics.
Isn't that crazy?
I don't think they are. I think there's going to be I think you're going to need to see the rise of, just like you saw the rise of retail investing through Robinhood. I think you're going to need to see the rise of crowdsourcing for Series A. And I can imagine a future. You didn't ask this question, but if you wanted me to say like 3 to 4 to 5 years from now, like what do I think will be normalized? I think asking your first customers to be your investors,
yes,
will be a normal thing to do. Not only are you asking for their revenue in a sales contract, but you're like, I can go get more companies like you. And, companies coming out and just investing 25, 50K in a startup they're working with is going to be a much more normal process. There's going to be simple online form you send them. There's going to be an investor relations person. There's going to be like an account executive pitching, trying to close them. There's going to be a client success person. And then there's going to be investor relations and say, hey, if you really love our stuff, you should talk to our investor relations. Let's go through the sales deck with you.
Yeah.
And that's just going to be part of the process.
Well, and it's the best. So that's the way I built a lot of my companies was, we got a buddy of ours, Ethan, who's building a company, and his superpower is helping medical device companies who sell medical device make sure they're compliant, and there's a certain researchy thing they have to do. And right now he's doing most of that through professional services, and he's got software that he's built that actually really, really helps with that. And so his big push and pull is, hey, do I do the professional services or do I do the thing? Really, what he should be doing, now that you've mentioned that, is approaching these big customers who really love the professional services, want the software, and say, why don't you invest in my company? And it could be a whole nother company that the software is held in. And he splits the two things out. And there you go.
I'm talking about practical workflow. I am saying that, like,
I used to have a horse named Practical Workflow.
On the first 10 employees,
yeah,
you start to hire an AE, you have an SDR, somebody going outbound, getting somebody in, an AE working to close them, get the business. And as they hand them off to client success, they say, is your company or any individuals in your company, are they interested in investing in our new company here? We have opportunities to get in on the ground floor and really see this thing grow. And then the buyer goes, oh yeah, actually, let's do it. And he goes, so I'm going to set up a demo right now with our investor relations specialist, and they're going to walk through the deck with you and talk to you about how to invest. And that's going to happen. I've never seen it happen, by the way. I've not seen this in practice, but the VC world is going to push towards this because founders are going to realize that there is no value add of that VC middleman.
Yeah, it's quickly running out. Like, we were talking to one who said, we are a super aggressive because we bring a lot of value add and all, and that's just tongue in cheek. It's just, no, we help with HR. No, you don't. No. What I need is customers, and I need funding. And yes, HR is a thing, and building the executive team is the next step. And I'm glad you can help with that next step. But I'm not taking your money because you're better at helping me with connections. I'm taking your money because I'm trying to build a thing that I already know how to build. I don't need that extra layer. So
Yeah,
interesting.
I think that extra layer is like if a founder can find a way to scale and directly go to LPs,
Mm-hmm.
and the LP doesn't have to deal with the management fees and all this other stuff, and they can become the retail investor for the venture at any stage. I'm saying any stage. Like, yeah, maybe they have to aggregate their capital up and say, like, we're raising $100 million Series F round,
Mm-hmm.
but I still don't need the actual VC mechanism. Like, maybe you do at that point because of regulations and other things, but the ability for the founder to go direct, these are the things I'm thinking about seriously doing on next venture. If we have another venture, I'm going to hire a salesperson, an SDR, a marketing person, and I'm going to hire an investor relations person. And their entire job is to continue to pitch the company. And I know that CEOs are supposed to pitch and all that, and you can get to the CEO before you make a decision. But this specialist walks through the deck, gauges your interest, make sure you're accredited, make sure you're all the things, sets you up and says, I think you're a good fit. Let's have you meet with the CEO. Let's consider bringing you in on this route.
What if that was the truth and the CEO was allowed to just build the company until the very end? What if, you broke the norm? What if that was a person, and maybe they weren't even an expensive person? What if that was a person who, was a $36,000 a year person?
Mhm. I
You
mean,
know,
I've thought about doing that at Hook, right? Where we have all these managed service providers and the like, that I have a partner success person, and then I introduce a partner investment specialist, and they just start calling our MSPs. And as part of the onboarding process, like, you can say no if you're not interested in investing, but if you would like to sign an NDA, get behind the scenes, Hook Security will tell you where we're at and where we're growing and how you can be a part of it.
so if you do the math, you have around 200 partners. You get, 1% of that, 2% of that, do $100,000 deals. You can get your scratch that way.
Mhm. Yeah, and you build your own little syndicate, your own little SPV.
I'll do it.
Put it-
I know how. I've done it. I know how to build an SPV.
I mean,
I'm
I'm
trying to
dead
get that
serious.
transaction, that sweet transaction money you talked about earlier. That's what I want to do.
That's right. I am like, I don't know if it's a 2023, 2024 thing, but like,
I think it's a
to build
2023 thing, man.
up Hook Security in such a way that I can bring somebody on who's willing to do that work, and then, like, in their free time is continuing to build VC pipeline, and like, they only bring me in when there's a GP to talk to, and we just say,
Yep.
hey, this is what we're doing. And as a VC fund, you participate in our thing. We don't participate in your thing. So if you want to come along, you have to write a check to our SPV, and here are the terms.
That's right. Now I'm the middleman who protects you from the middleman.
Yeah. I mean, I think I could find somebody and pay them 60, 80 grand a year to sit on these calls and get paid for success on the outcomes.
You could.
And I can clean up my cap table. I can have them do whatever. I can say, hey, we need to get 3 of our people on our cap table are ready to leave. They need secondary. We're going to raise $500,000. 250 goes to us. 250 buys these other people out. That's
I
your
like it.
prerogative for Q4. Let's go.
All right. I got some people in mind. They're really good at that. Oh, this goes back to one of our other podcasts that we did, which was paying somebody to raise money for you. This is not the same. This is a inside salesperson who is a part of a larger organization that is playing a key role. It isn't someone saying, hey, I'll get you the monies. I'm trying to decide whether or not that was a polite accent to use.
I don't know. You didn't offer me like olive oil or, threaten to hurt me. So it didn't seem too stereotypical.
I would like to apologize to
Although
the
it did
internet.
seem lazy.
Zach would like to apologize. Anyway, hey, we've gone on pretty good today. I'm proud of us. Hey, these things have been coming out in spurts because it's a full contact sport, what we're doing here. Running a fund, raising money from LPs, raising money from investors, running a companies, all this stuff. But it certainly is cathartic to have these conversations, and I'm glad we're recording them. And you really come across like you know what you're talking about. And I sure hope our listeners never actually fact check any of the things you say.
Yeah, as long as they don't find out what Google is, we're good.
Oh, you said the word. He meant Bing. Go use Bing.
Yeah.
Ask Jeeves. And scene.
Hey, and thanks for joining us for the TSOB podcast. Find us on LinkedIn and give us your hot take. The whole reason we're doing this is to get access to better conversations that help us up our game. And if you have something you want to share, we want to hear about it. Find us on the TSOB LinkedIn group and jump in with 2 feet. We can't wait to chat.